This week, we talk about alternative investments. What are they? But also, how do they fit into your portfolio? There are a lot of misconceptions with regard to risk, return, liquidity, how they fit in, how to do your due diligence. And we break that all down for you this week on Bullshift the podcast. Welcome to Bullshift the podcast. This is the podcast that talks about how the financial services industry shifts your attention to make you feel more bullish. My name is John DeGuy. I am the host of the podcast and the author of the book Bullshift. My guest this week is Vikram Rajagopalan. He is a CFA and has recently started his own firm, which is called 2.0 Capital Partners. His goal is to match investors who are looking for new opportunities to get into, grow their exposure to non-correlated alternative strategies with investment managers who are willing to meet that level of governance, transparency, and track record, which is required to meet their trust. Vikram, welcome.
Thank you, John, and always enjoy being on this podcast. So thank you for having me on.
A fun thing that I could mention right off the top is that you are the first person who is a repeat guest. So I've done over 70 episodes of Bullshift the podcast. And because your role has changed and you're wearing a different hat, I want to get your insights. You're a very insightful guy to begin with, but I want to get your insights now in particular with regard to 2.0 Capital Partners.
And I guess now people know how to get on here for the second time. They've got to change roles, I guess. They've got to make a real, and you've had some very successful people on your podcast. So I'm curious to see how much it's worth to them to change their entire career.
There you go. Let's see if we can begin by having you walk us through by what you're doing now with 2.0 Capital Partners. What's the vision of the firm? What are you hoping to accomplish?
Thank you, John. And I think, look, for those that know me in the alternative world, the last 12 years I've been at one firm, one of the largest private mortgage lenders in the space by the name of Trez Capital, a market leader in the space. Very proud of the work I sort of did there. And again, I guess I was fortuitous in that journey to meet so many different allocators, so many different investors, all with different needs. We were a market leader not only on the real estate side, but we were also market leaders on investor education, being ahead of trends and understanding where the industry was sort of taking us. And so ultimately, as I sat there for the last year or so, it became evident that this alternative space, as I like to call it, alternatives is a very generic term. I mean, alternatives in my mind are non-correlated assets. We can argue what that looks like, but that is technically how I look at it. It's here to stay. It will continue to grow. Yes, there's some noise around it right now, but there's noise around everything, but it's definitely here to stay. And people continue to look for these type of niche managers in their portfolios. But I got a sense talking to allocators that more people are confused of what questions to ask. How can you avoid the landmines? How can you again, everything looks good on paper and a presentation. So I really saw a need, given my experience and looking at the last 10 or 12 years, talking at a very detailed level with a lot of different people, that I could really, in I guess in a selfish way, take advantage of this trend, which is marrying up not only the want to continue to add non-correlated assets, but also educate people what questions to ask and represent those managers from either anywhere around the globe or just here in our here in our backyard of Canada, that are willing to answer these questions, willing to go above and beyond their normal scope when it comes to transparency and governance, and really, again, help them grow and help investors find really good assets to invest in, really good funds to invest in. And that's easier said than done. In the short term, I found that, but it's something I'm very passionate about, and that's kind of the vision. Really, it's simplistic in nature.
So you talk about a lot of alternatives, and I'm wondering if I could ask you to be perhaps a little more explicit about what you mean by what these alternatives are. Can you perhaps give us some examples of what an alternative asset is. I don't need to know the name of a product, but maybe the strategy, what it is that people invest in if they invest in alternatives, which are separate and distinct from publicly traded capital markets.
For sure. And I think the top two ones that are spoken about today are real estate and private debt, right? I think those are the top two, and I think it's spoken ad nauseum. And so there's some great players on there. There's some good players, and then some obviously not great players in there. What I'm looking at is actually going a sort of layer deeper than just those generic kind of terms of real estate and private debt. And what you look at, so for me, again, I get back to it. Why do people invest in alternatives in general is because it enables them to match their return expectations, their long-term return expectations with the steady Eddie returns that these alternatives tend to provide. On the flip side, they give away liquidity, right? And they give away that ability to buy and sell these things on a daily, monthly, on a monthly level. So really, it's about the fact that if you're bringing these alternatives into your portfolio, you have to know it's not a landmine. That is the only thing with some of these privates. Either they're really, really good and they do exactly what they're supposed to do, or sometimes in the midst of all of it, as we've seen, it can turn bad in a hurry in sort of these ways. So, for example, I'm currently I will be representing a firm based out of Saskatoon, no less. This firm does acquisition financing of small to medium-sized businesses, enterprise value from $10 million to $50 million. Why do I like it? Because thematically, it is addressing an issue. That's the other thing. It must address an issue today of put it 100,000 businesses across North America that need some kind of succession planning to the next generation, and they provide that solution to those companies as there's a generational wealth. And you know this, John, as a portfolio manager, the generational shift of wealth from business owners, and they just don't have a way out of the succession planning, and this firm provides that. And in return, investors get a very steady debt return of the sort of low teens plus 10% participation in those companies. And I like it because one, it addresses a thematic investment, and one it's something you don't normally see. It's you usually see private debt, factoring, all of those things, but you don't really see something solving for that particular issue of just pure succession planning. Having come from the alternative industry, I see it all the time, right? Companies where they require an exit strategy and all of those things. You look at thematic investments in Europe, right? You turn to what's happening in Europe right now from a political standpoint, and you say to yourself, what does that real estate market look like? What does that private lending market sort of look like? And can we educate investors on some of the stuff going outside of myopically of North America, right?
So can we maybe talk a little bit then about transparency and governance? You were saying that that's one of the main differentiators and one of the things that the landmines that investors need to be mindful of, and you can help them in sussing out, what's more reliable than maybe other things that might be out there. Help us to understand what you'll be doing and what your role is, and what the role of anyone who does a responsible job of sorting through myriad different alternative investment products and strategies to make sure that they're actually getting the real deal when it comes to governance and transparency.
For sure. Thanks, John. Look, I made this quite clear to most managers I'm speaking to. I think given the environment we're in, when an investor asks you for certain data, you do not now have much of a right to say no, right? I mean, ultimately, investors have a right to it as long as it's not selective disclosure. That is the one thing I think managers have to realize. What you give to one, you give to all, right? Because that is the one thing about it. Two is to understand bigger is not always better. I've always said this. One of the detriments of long-term returns is just growth of assets, because When it's small, you get to look at it. It's bricks and mortar. You don't have that many portfolio holding, but you have to ensure that as the manager grows, and how have they managed that liquidity? Have they become diversified? Are they grown from 200 to a billion with the same amount of loans in the portfolio? Have they just made certain amount of their constituents just bigger, or have they actually diversified their portfolio base? And are you going to allow investors to have the look through, right? Because you've got to understand, John, like a lot of these smaller managers grew on the backs of their friends and family. They grew on the backs of ultra high net worth clients, some of them who have obviously great faith in what they do. So they don't tend to ask as many questions beyond just this is the individual. But now as you go to it, is educating them on the investor has every right to ask all the questions. You have a right to say whether or not that breaks your competitive advantage, and they have a right to walk away. But also to understand, just giving one investor answers, it has to not be selective, and they have to have a look through on it. On a governance, sorry.
Okay. I was gonna let's see if we can go a little bit further on the due diligence. Let's assume you've done the due diligence and you've gotten your answers with regard to disclosures, with regard to governments, with regard to the whole ball of wax. Help me to help my viewers and listeners understand what alternatives are as an option relative to stocks and bonds, and that includes ETFs and mutual funds. 100%. What are the main differences?
Yeah, look, as someone like myself who has roughly 40% of his portfolio in alternatives, I can talk. I sort of talk about what it means to me. It is again my first of all, I will say this, it's my personal thing. I don't own a bond. I will not own a bond. Even regardless of how interest rates are going, if you look long term, I don't see much of a benefit to it, because liquidity does not matter to me as much. Equities, you know what it fulfills. It is one of those things that gives you long-term potential growth in your portfolio. It is the one that gives you consternation. It's the one that also gives you the ultimate happiness in good times. It is a valuable part, fully liquid portion of your portfolio. For me, alternatives is the private side, buying private markets, having that sort of non-correlated, so you're not seeing these constant swings in your portfolio, having a long-term vision. Because again, I was here, you were here when those great Dalbar studies were out there that said, look, ultimately giving investors full liquidity is to their own detriment in most cases. And so having alternatives where you're not able to sell has actually benefited for the most part. So it's about when you look at it and you say, I'm a high net worth investor and I require 7.5% to 8%. I'm obviously musing here, but just say it's 8%. If I was in a traditional portfolio of fixed income and bonds, how much pressure am I putting on my equities now in order to get that 8%? But if I was in some very good private debt, senior lending funds, or anything of that nature, and I'm able to get, say, 10%, okay, then I'm not putting as much pressure on my equities, because that's where you kind of go with risk. I'm a big proponent of diversification. Stocks 100% matter. I think bonds do if you're a bond aficionado. I think my pet peeve, and maybe we'll get to this, how many people have become bond aficionados apparently overnight. But again, ultimately, that's where I think the balance lies. I don't know if that.
What is interesting? One of the things I talk about in Bull Shift, and I've had a few other guests talk about this on this podcast as well, is that FP Canada puts out annual assumptions guidelines with regard to expected rates of return for different asset classes. And the expected rate of return for Canadian stocks and U.S. stocks is below 7%. I don't know if you're aware of that. And so as a result of that, a lot of the things that you're talking about as alternatives can get you possibly a higher return, but almost certainly a higher risk-adjusted return, which is to say, a comparable return, but with less volatility. The real thing that investors have to think about if they're going to get into alternatives is their need to be able to get out in a day, because we're now at T+1 for securities. And whereas with alternatives, oftentimes it's 2 or 3 months if you can get out at all. Sometimes it's locked up for a very, very long time. So I think that would be the main difference. Can you maybe offer your thoughts on why Well, you say you're at around 40% in alts. Let's look at it this way. What would you say an informed investor who wants to replicate a pension fund, a teacher's pension or a Canada Pension Plan Investment Board sort of portfolio to try to get more stable, steady returns, who has an indefinite time horizon? What do you think most people should be in? What percent do you think most people should have in alternatives, and why? And what would need to happen in order to get there? That's like a three-part question.
Yeah, like I appreciate the question. Again, yeah, I'm sure you appreciate this for all intents and purposes. I'm not giving advice here on how to manage your portfolio, but ultimately, what is the biggest change in privates is that most of them have now been distributed through fiduciaries like yourself that have an intimate knowledge of the client, right? From a perspective of their longevity, how much they need. The first thing I always say is how much you need in alternatives is purely determined on how quickly you need your capital, right? I mean, look, if I get calls from advisors all the time, can I put it in this product? And I want to buy, because my client wants to buy a house in a year. No, I mean, you run too much risk there if you have a definite need for that money in a short period of time. So you have to build out. If you say someone has indefinite, then they definitely invest like the institutions. My pet peeve has been people who say invest like the institutions. Like, I love alts, but I also recognize teacher's pension plan does not have the same liquidity requirements I do, right? And so let's not be naive about that. Let's not be naive about that either. So how much does someone have is purely based on, again, John DeGuy sits down with a client and says, what is your required rate of return and how much risk do you take, and when is your laddered need for liquidity? If the client's like, look, my investment portfolio, and that's personally for me, my investment portfolio, I do not have to touch at all for the next, decade or so. I'm patient. So are you patient capital? Are you not? I love the 40%. Personally, for me, that makes a ton of sense. Everything on a bell curve falls 60-40. Right. And if 40% of your portfolio is not instantaneously liquid, I think that is a great diversifier. An old advisor, when I started at this business 12 years ago, when I say this business, the alternative business, said to me, if your portfolio is 100% liquid, you're not well diversified.
Right. That's a really good way of looking at it.
And so for me, it falls 60, but again, it might be 20, it might be 30. It all depends, right?
What is interesting is that Ciro, a year and a half ago, or 2.5 years ago now, I guess it's 2.5 years ago, changed the way advisors and portfolio managers build portfolios in terms of their profiling. It used to be you would look at a new client application form and have a certain percentage in cash and in bonds and in stocks. And now it's low, medium, high. Yeah. And you're looking at the risk characteristics of an investment rather than the actual underlying asset class, which I would argue makes more sense. So that, I think that's a good step forward. What's interesting, though, is that there are lots of alts, especially if you get past the liquidity, which in most instances, most alts you can get out of in, let's say, 2 months. Yeah. So as long as you have the ability to withstand, getting your money out in 2 months, most of the products would otherwise be rated as medium risk, which is not really that different from stocks. And so when you look at it in terms of how much you could put into alts, there's obviously the principle of being diversified. You don't want to be 100%, but you could be very high and still be entirely compliant, because what you're doing is all you have to do is make sure that you satisfy the risk concerns and constraints that a client may have, but all of the other concerns and constraints with regard to variance, standard deviation, risk, the way we would normally define it, are usually comparable, and in many instances actually lower than traditional stock markets.
I have to tell you, you've hit a topic that is near and dear to my heart, which says you can add a risky alternative. Yeah. And if you put 100% of your money in that risky alternative, you're lunatic. But if you add this risky alternative to a portfolio and look at what it's done to a correlation portfolio, you could argue adding that risky asset made your portfolio less risky.
Lowers the risk, exactly.
From correlation. And look, I think that's a part of it the industry has not got to, because they're looking at myopically from one product to another versus the entire portfolio construction. I have seen some independents that look at it from an entire portfolio construction, and they've done incredibly well. And I think that that's the way people look at it, is that, look, If I had 100% of my thing in Bitcoin, I'm an absolute lunatic. But maybe adding a little bit of Bitcoin in my portfolio is actually like, I'm glad, because when this does terribly, the Bitcoin is shining, and I kind of like that, right? And so I think that is again looking at that entire portfolio. It's not done very often. Those that do it, and I'm not talking from an advisor level, from a full on from your fiduciary dealer level. The more that can come into fruition, the better they will be for it.
The way that I like to explain it to people is Harry Markowitz came up with the notion of modern portfolio theory in the 1950s. He ended up winning the Nobel Prize for it. And the whole idea is the so-called efficient frontier, where you get a better risk-adjusted return, and you add assets that are weakly correlated and sometimes even negatively correlated. And that's exactly Markowitz's big insight. You could add 5 or 10% of something which is riskier than the other 100% that's currently in the portfolio. But if it's zigging let's say you put in 10%, when the other 90% is zagging, the entire portfolio as a whole will be less volatile than it was before you added the 10% volatile thing.
And I think look, I'm sure you're going to ask me about my pet peeves. I think, but I'm going to get to it anyway. Is the fact that the narrative for so long, and I hate using the word narrative, but it has been, is that the people that were 100% stocks found alternatives to be this enemy of the state, right? Because it was taking away from what they were going to do. And the narrative's been like, alternative providers have been going out there saying, don't hold any stocks, don't hold any liquidity, hold 100% us. That has not been, at least from my case, and I've been at the head of like one of the large, that has never been the case. And really, it's that chipping away at this, right? Chipping away, like you'll get these guys on the equity side that says, why would you ever invest in this? You can't get out of your money. That's fine. But we're not saying not to invest in you. We're saying that addition of us maybe negates some of your risk, right? Which is, and you're not a riskless manager either, unless you're going to propose you're fully guaranteed either. So it's one of those things that lends copacetically to one another. Now the alternative players will fight with one another in terms of who's the best in that case, and the stock guys do. But this narrative that somehow, why would you go? And sorry, I'm going to go into this. It's what I find always funny about the people in the stocks is that they sell on the whole premise that the markets are inefficient and do not price efficiently. Therefore, there's always value in the markets, except when it comes to privates, because when it comes to privates, the market markets it efficiently. Therefore, the privates are mispriced. Right. So when it comes to the privates, they would say that the publics do it efficiently. But when it comes to just investing in stocks and clients say, look, I want to get out, they would say, no, it is mispriced in the stock market. Which one is it? Does the market?
It strikes me as being exactly perverse. Yeah, the exact.
Does
opposite.
it price it efficiently? Does it not price it efficiently? Make a decision, right?
Pick a lane.
Yeah.
Let's see if we can get to the way we always like to end, which is that's bullshit. If it was up to you, Vikram, what exactly would you say is a pet peeve of yours with regard to the way the financial services industry is working in 2024?
Where do I start? But look, I think actually my attention is turning on not just a narrative out there, right? I mean, billions of dollars, John, are being held more, I think the last 13 to 15 billion dollars are being held in fixed income funds that are generating negative returns over the last 5 years. Most of those are being held by retirees that need that income when they get out. But there's absolutely zero talk of that in the last one. The erosion of wealth, except all focus is on the odd bad story in the alternative space and this sort of liquidity mismatch that's taking place, which I will contend is happening. But I don't know why it continues to be this big hot ticket item. Not everyone is naive to it. People that got in knew what they were getting into. I don't think people are as naive as they sort of try to make it out to be. It's an educational process. I continue to say it. We're not, all privates are a part of a diversified portfolio construction, a pet peeve. Look at it from an entire portfolio perspective. You don't have to.
So then let's get to shift happens then. So you've been clear that you don't like the way people are still thinking in the old school manner with regard to bonds. If it was up to you and you could change the way things are done, How would you change the way people invest right now so as to mitigate the problem you just identified with regard to income products?
I would hope, as you know, and again, the viewers of this, I don't know how much they know about how dealers risk rate or anything of that nature. But I would hope as systems evolve, I would love to see systems that look at portfolio risk, not just individual myopic asset class risk, and see how your correlation is. So for example, if John DeGuy builds a portfolio that is well diversified and has a correlation of X, it is less risky than Y, even though he's completely and fully liquid assets. If I would love to see that transition, and I would love to see a consistency across the board, because a client, one individual client, depends on who they invest in, can have the same things completely differently risk rated, right? And I think that causes confusion across the industry. So I'd love to see some consistency. I think it's happening every day. There's talk about it. I think people are starting to see that, but I'd love to see. I've always been a big proponent of even playing ground, as opposed to just banks want to do this, the independents want to do this, they want to do this. It's just like an even playing ground where the rules are known, right? Sure. And right now we're not there yet, but I'm sure there's a lot of advocacy towards that.
And that's great, and that's a happy thing to wait. It's a nice way to end, because it's a vision of a more positive future that we can all hope will be coming down the pike. So that's wonderful.
Well, more people like you, John. Come on.
There you go. Vikram, thank you so much. I really enjoyed our conversation. I want to wish you all the best in the future.
Thank you, John. Take care.
John DeGuy is a portfolio manager with Design Securities in Toronto. He is the author of both Bullshift, How Optimism Bias Threatens Your Finances, and Stand Up to the Financial Services Industry, Protecting Yourself from Well-Intended but Oblivious Advisors. The books are available online and in bookstores everywhere. The opinions expressed on Bullshift and Shift Happens should not be construed as investment advice. You can reach John at jdeguy@designsecurities.ca or at 647-STAND-UP. That's 647-782-6387.